The next adjusting entry we talk about is depreciation. Instead of expensing the cost of a plant asset in the year it was purchased, we allocate or spread out the cost over its entire useful life. This is called depreciation. The formula for straight line depreciation is the total asset's cost minus its salvage or residual value divided by its useful life. Different types of equipment have different useful lives. Useful life is the period of time that we expect to use the asset to produce revenues. It expires as a use of wear and tear or because the business no longer needs it. So different equipment that we purchase, such as our desk computer or any machinery that we use, our copier, if we have a car for our business, those are all things that we are going to depreciate over a useful life. The useful life of those items is various. The salvage value is the expected selling price of an asset at the end of its useful life. This is also called its scrap value or residual value. Sometimes we have items that we use that once we're no longer using them, they still have a nominal value and we can sell them secondhand or used and recoup some of our money. When we adjust for depreciation, we have this information. So step one is that we purchased equipment for $26,000. This equipment has an estimated useful life of 5 years. The equipment is expected to be worth $8,000 at the end of 5 years. We purchased the equipment on December 1st, but it is now December 31st. Therefore, we need to record an expense for the use of the equipment for 1 month. Because we expect the equipment to be worth $8,000 when the 5 years are over, we're only going to expense $18,000 of the cost over the next 60 months. So we have $26,000 minus $8,000 divided by 60 months, or 5 years, which is our useful life. So we calculate that net cost, the amount that we're going to depreciate. So the amount that we depreciate is the original cost minus our salvage value. Then we divide that by its useful life. Our useful life is 5 years, which is 60 months. So when we divide that $18,000 over 60 months, we get a depreciation expense of $300 a month for that equipment. We would record a journal entry, a debit to depreciation expense for $300, and a credit to an account called accumulated depreciation for $300. We accumulate depreciation in an account called a contra asset. So instead of reducing the amount of the asset account, we have an additional account that we only record the accumulated depreciation for. So our adjusting entry is a debit to depreciation expense and a credit to accumulated depreciation equipment. Then on our balance sheet, in our assets account, we will show equipment less accumulated depreciation for that equipment. So this is an example of this company's balance sheet after 3 years or 3 months of depreciation has been recorded. So after 3 months, the equipment is shown net of accumulated depreciation. Next, we're going to look at adjusting entries of revenues and expenses. And first, we're going to look at revenues. Deferral of revenue. So this is unearned revenue. This is when we receive cash but have yet to provide the products or services. There are many different situations in which this occurs. The most common of these is a subscription service that is paid months in advance. For example, if you pay for Amazon Prime, you pay once a year for 12 months of Amazon Prime services. So you give all of your cash to Amazon Prime in 1 month. My month is in April. That's when my Amazon Prime account renews, is every April. I give Amazon money in April, and they owe me a service for that for the next 12 months. They can only record that revenue every month as they earn it. The other way to have unearned revenue is if we have contracts with businesses or our clients. So for example, I contract a service out and they give me a deposit. I can't record that deposit as revenue until I perform the service or provide a product. Until then, it is unearned revenue, which is a liability. In this example, we have a 60-day fee that our clients pay us, and we paid it in advance. So we paid in December for 2 months of service. We earn payment as time passes. On the 31st of December, we've earned 5 days of that service fee, or 5 divided by 60, the 60 days, times the total amount that they paid us of $3,000. So we've earned $250 of that revenue at the end of the month. Therefore, we would record, when we have this cash, $3,000, and unearned consulting revenue for $3,000. Our adjusting entry would be a debit to unearned consulting revenue and a credit to consulting revenue. This will show that we still have a balance of unearned consulting revenue over the next 55 days. And our income statement will show that we have earned total consulting revenue. That adjusting entry is a debit, as we said on the previous slide when we were looking at the T accounts, of unearned consulting revenue, and a credit to consulting revenue. The next cost that we're going to look at is called an accrued expense. So this is a cost incurred in a period that is both unpaid and unrecorded. Normally, one of the most normal expenses that this occurs with is our salaries or wages expense. So we might pay employees 2 times a month, but the employees work for us all month. When they work for us, we accrue an expense that we're going to have to pay at a future date. So after so many days have passed, we know that we've owed employees for so many days of work. We accrue that as an unpaid expense, which becomes a liability. So in this example, we have a salary. We pay our employees $70 per day, or a total of $350 for a 5-day work. Salaries are paid every 2 weeks on a Friday. December 31st is on a Wednesday. So at the end of the month, we have to close the month. We're not going to pay our employees until Friday, but we have to record the expenses portion that goes with December. Thursday and Friday's wages are going to be in January. So the 31st is a Wednesday. We owe 3 days salaries at the end of the year, which equals $70 per day times 3 days. We create adjusting entry. We have salaries payable, and we have a salaries expense. So our journal entry is a debit to salaries expense and a credit to salaries payable. The income statement shows the entire salaries expense for the month of December, And our balance sheet will show that we now have a liability of salaries payable that is accrued wages that will be paid sometime in January. Then we'll pay those expenses. So we accrued the salaries on December 31st. Our normal payday then is January 9th. We will pay employees for that accrued $210 plus any expense that we owe them for working in January. So we have the salaries payable that we recorded at the end of December with our adjusting entry, salaries expense, which is the 7 days of salary that they've worked in January, and then cash to pay our employees. Accrued revenues are revenues earned in a period that are both unrecorded and not yet received in cash or other assets. So in this example, we have a customer that has agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. On December 31st, we have been providing them 20 days worth of services. We've earned $1,800 or 20 of 30 days. So we need to create an adjusting entry which gives us accounts receivable and gives us consulting revenue. So instead of prepaying us, they've agreed to pay us for services rendered. Therefore, we've allowed them to take services on credit, and we expect to be paid on January 10th, which gives us an accounts receivable. On December 31st, when we make our income statement and our balance sheet, we will show that they owe us $1,800, and we've had total income statement of $7,850 in consulting revenue. Then on January 10th, they will pay us the amount that they owe us. So we will record that we have received $2,700 in cash. We'll remove that accounts receivable that we recorded on December 31st, and we will record the revenue that we earned for 10 days in January.